So if you're new to options trading, watch this before you buy your first call or put, because options are not stocks. They move faster, they expire, they lose value over time, and you could be right about the direction of the market and still lose money. That's what catches most beginners off guard. They think, oh, if SPY is going up, I'll just buy a call. Or if I think the market is going down, I'll just buy a put. But options trading is not just about direction. It's about direction, timing, volatility, contract selection, risk management, and discipline. So before you jump into the market trying to flip a small account, let's talk about what you actually need to understand first. Let's get into it, y'all. Let's do it.
This ain't lean, this espresso off in my cup, I'm sipping. I been up, if I ain't got it, you know I'm on the way to go get it. Ain't gotta flex, ain't gotta talk, they know this shit is different. Whole lot of comments while I talk like, hold up, wait, let me finish my sentence.
Peace, y'all. This is Juug the Market, where we break down the market, the money, and the system behind the charts. So today, we are talking directly to the new options trader. Not the trader who already knows everything, not the trader who's pretending to be a guru. I'm talking to the person who is trying to learn options the right way before the market teaches them the hard way. Because options can be powerful, but if you do not respect them, they can humble you fast. So this video is about building the foundation. Before strategy, before 0 day to expiration, before SPX, before trying to double an account, you need to actually understand what you're trading. So let's break it down. So what are options? Let's start simple. An option is a contract. It gives you the right, but not the obligation to buy or sell an asset at a specific price before a specific expiration date. So there are two main types of options, calls and puts. So a call option is usually when you think a price is going up, and then the put option is when you usually think a price is going down. And by price, I mean stock price. So, but here's where beginners mess up. A call is not just price goes up, I make money. And a put is not just price goes down, I make money. Because the contract itself has other factors that's affecting it. Time affects it, volatility affects it, strike price affects it, expiration date affects it, the speed of the move affects it. This is why options require more understanding than just picking a direction. So, and let's go into the actual definitions. So the full definition of a call. So with a call option, a buyer has the right, but not the obligation, to purchase an underlying asset at a predetermined price before a set expiration date. Investors buy call options with the expectation that the asset price will rise, allowing them to net a profit by buying the asset below market value. Now, for puts, the definition of puts. Put options are derivatives that give holders the right, but not the obligation, to sell an underlying asset, such as a stock, currency, bond, commodity, future, or index, at a set price by a pre-established date. So you got calls are buying, puts are selling. Now, options are contracts, not shares. When you buy a stock, you own shares. You know, you buy one share of a company, you own that share until you sell it. So until you actually do away with it and sell it to somebody else, it's yours. If you want to hold on to it forever, you could do that by all means. But when you buy an option, you do not own the stock. You own a contract connected to the stock, ETF, or index. For example, if you buy a SPY call option, you do not own SPY shares. You own a contract that changes in value based on what SPY does, how much time is left, how volatile the market is, and how close your strike price is to the current price. This is why options can move so fast. You're not just trading the price, you're trading a contract that reacts to the price. And this contract is basically for 100 shares, whether you're buying or selling, or whether it's a call or a put. Every contract is for 100 shares of that underlying stock or whatever stock you chose. So every option has an expiration date. This is one of the biggest things beginners need to understand. Options expire. That means the contract has a deadline. If the move you expect does not happen before the expiration date, the contract can lose value or even expire worthless. That is completely different from buying shares. With shares, you could buy in early and still hold. With options, being early can cost you some money. You may be right that the market eventually moves up, but if your call option expires before that move happens, you can still lose. That's why timing matters so much in options trading. You're not only asking, where's the price going? You're also asking, how soon can it get there? A price of an option is called the premium. This is what you pay to enter the trade. So here's a simple example. If an option is listed at $2, that usually means the contract costs $200. because most standard option contracts represent 100 shares. So when a beginner sees a contract priced at $2, they need to understand that the real cost is usually $200 per contract. That premium is what's at risk. If the trade fails, that premium can drop quickly. And if you're trading short-dated options, that premium can move extremely fast. This is why position sizing matters. So why options move so fast? Options move fast because they are leveraged instruments. Leverage means you can control the exposure to a large move with less money up front. This is what makes options attractive. But this is also what makes them dangerous. A small move in SPY or S&P 500 can create a large percentage move in the option contract. That can work in your favor, but it can also work against you. This is why beginners get excited when they see someone make 50%, 100%, or 200% a contract. But they do not always see how fast that same contract could have gone down 50%, 70%, or 100%. Options give you speed, but speed without control is dangerous. The main reasons beginners begin to lose money is not only because they pick the wrong direction, but they lose because they do not fully understand the trade. So here are some common reasons. They buy contracts that expire too soon. They buy too far off the money. They overpay for contracts when volatility is too high. They hold too long. They average down with no plan. They trade too many contracts. They revenge trade after a loss. They enter without a stop loss. They chase candles instead of waiting for setups. And the biggest one of them all, they risk too much money on one trade. This is how a small account gets destroyed. Not usually from one bad idea, but from bad habits repeated over and over. And direction is only one part of the trade. And this is one of the most important lessons of the whole video. In options trading, being right on direction is not enough. You can think SPY is going up, SPY can actually go up. And you can still lose money if the move is too slow, if you bought the wrong strike, if time decay eats the contract, or volatility drops. This is why option traders need to think differently. You're not just asking, do I think the price is going up or going down? You're asking, what is my setup? What's my entry? What is my expiration? What strike am I choosing? How much am I risking? Where's my stop? Where's my target? What will prove this trade wrong? This is how you start thinking like a trader instead of a gambler. So risk management comes before profit. If you are new to options, your first goal should not be to make a lot of money fast. No, not at all. Your first goal should be to survive long enough to learn. Because if you blow your account in the beginning, you're never going to give yourself time to build the skill. For me, risk management has to come before profit. That means knowing how much of your account you are willing to risk before you enter. It means not putting your whole account into one contract. It means having a stop loss. It means understanding that not every setup is worth trading. And it means accepting that your losses are a part of the game. A good trader does not avoid every loss. A good trader controls the size of the loss. So one way I like to simplify risk for a beginner is with two rules. First is the 10% rule. That means I do not want to put more than 10% of my account into a trade. So if I have a $1,000 account, I'm not trying to throw the whole $1,000 into one options play. I will only use up to $100 for that trade. The second rule is that I use a 20% stop loss. So if the risk is $100 on that trade and my stop loss is 20%, I'm actually cutting the trade down of a loss to about $20. So I only lose 20. This keeps the loss controlled because the goal is not to be perfect. The goal is to stay in the game. Small controlled losses are a part of trading. Big emotional losses are what destroys accounts. So if you're brand new, do not start with 0 DTE. Be careful with 0 DTE options. And 0 DTE is 0 days to expiration. So 0 DTE means the option expires in the same day. These contracts can move fast, but they can also lose value extremely fast. So the closer you get to expiration, the more sensitive the contract becomes. This means you need discipline, speed, and a clear plan. If you do not understand options yet, 0 DTE can feel exciting, but can also be one of the fastest ways to blow an account. Trust me, I've done it many times, many times. So before trading 0 DTE, learn how options work. Learn calls, learn puts, learn premium, learn expiration, learn the Greeks, learn risk management, learn how to read the market. Then you can decide if 0 DTE fits your trading style. Do not start with the most dangerous version of the instrument before you understand the instrument. If you are new to options trading, focus on the foundation. Learn what calls and puts are, learn what premium is, learn what expiration means, learn what strike price means. Definitely learn the Greeks, especially delta, gamma, theta, and vega. Learn how SPY and SPX move. Learn how to mark key levels Learn how to wait for setups, how to manage risk, and how to journal your trades. And most importantly, learn how not to trade. Because sometimes the best trade is the one you do not take at all. So your goal as a beginner is not to trade every move. Your goal is to build a process. You have come into options trading with the right mindset. This is not a lottery ticket. This is not a quick flip machine. Options trading is a skill. And like any other skill, it takes repetition, discipline, and review. You're going to make mistakes. You're going to miss trades. You're going to take losses. You're going to enter too early sometimes. You're going to exit too early sometimes. But the goal is to keep learning without destroying the account. The trader who survives long enough to learn has a chance. The trader who gambles everything early usually does not. So what I would tell myself as a beginner, if I could talk to myself when I first started trading options, I would say this: slow down. Learn the contract before chasing profit. Do not trade just because the market is open. Do not risk money you cannot afford to lose. Do not copy random trades without understanding why. Do not average down with no plan. Do not let one loss turn into 5 losses. And never forget that cash is a position. You do not have to trade every day. You do not have to catch every move. You just need a repeatable, profitable process. So before we close out, if you're serious about building a better trading process, make sure you subscribe to my email newsletter. When you subscribe, you'll get my free pre-market prep checklist, because before you ever buy a call or put, you need to know what kind of market you were getting into. So you need to check the economic calendar. You need to check major news. You need to check the VIX, the SPY, QQQ. You need to define your bias. You need to know what an A+ setup looks like to you, and you need to know when not to trade. This is exactly why I created the pre-market prep checklist. It gives you simple structure to follow before the market opens, so you're not just chasing candles emotionally. So if you want the free checklist, subscribe to my newsletter. The link is in my description. So let's wrap this up, man. So if you are new to options trading, here's the main thing that I want you to remember. Options are powerful, but they are not simple. They are contracts, they expire, they lose value over time, they move fast, and they require discipline. Do not rush into options trying to get rich fast. Learn the instrument, learn the risk, learn the process, and then build from there. This is Juug the Market. We're not here to gamble blindly. We're here to understand the market, respect the risk, and build discipline one trade at a time. Like, subscribe, and tap in for the next video, y'all. Peace.